Hey everyone, and welcome back. Have you ever, really looked at that dollar bill in your wallet? It's just a piece of paper, right? Well, it's also a symbol of global power that basically runs the world of trade, finance, and even politics. But how did this little green piece of paper get to be king? And the big question on everyone's mind, is its reign about to end? Okay, let's dive in.
So, to really get a grip on the dollar's power, we gotta go back to basics and ask a pretty fundamental question. What even is money? At its heart, any kind of money, whether we're talking about a seashell, a gold coin, or a number on a screen, it's just a shared belief. It's a tool we all agree has value so we can trade it for stuff we actually want, like, pizza or a new pair of sneakers.
So that brings us back to this piece of paper. What actually makes it valuable? It's not the ink, it's not the fancy paper it's printed on. The real value comes from all of us believing in it. The fact that you, me, a shopkeeper in Tokyo, and a banker in London all agree that it's worth something, that's the magic. We accept it as payment because we have faith that the next person will accept it from us. It's basically one giant global trust fall.
Now, for a long time, that trust was actually tied to a real physical thing. Under what was called the gold standard, you could literally walk into a bank, hand over your paper money, and get a real chunk of gold in return. But today, pretty much the whole world runs on something called fiat currency. And this is where it gets a little wild. It's not backed by anything physical at all. Its value comes entirely from our collective faith in the government that issues it.
Okay, so this brings us to our main character, the US dollar. Its journey to the very top of the financial food chain really kicks off in the aftermath of World War II, when the entire world was just desperate for some kind of stability.
The whole thing really boils down to two huge moments. First up, 1944. The world's leaders get together at a conference called Bretton Woods. They decide to peg all their currencies to the US dollar, which in turn was pegged to gold. And just like that, boom, the dollar becomes the world's anchor. Then you fast forward to 1971. President Nixon does something that stunned everybody. He completely severs the dollar's link to gold. They called it the Nixon shock.
The original idea behind Bretton Woods was incredibly hopeful. The famous economist John Maynard Keynes was there, and he said the goal was to create a system where, quote, the brotherhood of man will have become more than a phrase. They genuinely believed that if countries were economically tied together, it could prevent another devastating world war.
Now, you'd think that cutting the dollar off from gold would make it worthless, right? But the craziest thing happened, the exact opposite. By that point, the whole world was so dependent on dollars for everything, there was really no other option. So the Nixon shock didn't weaken the dollar, it accidentally made it even more powerful, cementing its place at the top, now backed only by the full faith and credit of the US government.
So this unique position gives the United States something a French finance minister famously called an exorbitant privilege. Let's break down what that really means for the US and for the rest of the world. To put it simply, because the whole world needs and wants dollars to do business, to save, to invest, the US gets a whole bunch of economic and political perks that no other country gets. It's kind of like being the banker for the entire planet.
And the benefits are, well, huge. This constant global demand for dollars means the US government can borrow money at lower interest rates. That benefit trickles down to businesses and even to us with things like home mortgages. It also makes all the stuff we import cheaper. And here's the big one. It gives the US incredible leverage. Because most big international transactions have to pass through the US banking system, Washington can essentially freeze a country out of the global economy.
But it's not all sunshine and roses. This privilege has a flip side. A strong dollar makes American-made goods more expensive for other countries to buy, which can hurt our export businesses. That dynamic also leads to these massive, ongoing trade deficits. And, that ability to borrow money so easily, it can be a real temptation for the government to pile on more and more debt. So for decades, this has just been the way the world works. But lately, things have been changing. The dollar's top dog status is being questioned more and more, and we're starting to see some potential challengers step into the ring.
All right, so here's a snapshot of where we are right now. Take a look at this. As of early 2024, the US dollar makes up almost 60% of all the reserves held by central banks around the world. The euro is in a very distant second place at 20%. So yeah, no question, the dollar is still the king of the hill.
But here's the interesting part. Look at the trend. While 59% is still a massive number, it's actually down from over 71% back in 2001. So what we're seeing isn't some sudden collapse. It's more like a slow, steady erosion, a gradual chipping away at that total dominance as countries quietly start to diversify their holdings. And that leads to the million-dollar question, or maybe the trillion-dollar question. If the dollar slice of the pie is getting smaller, why hasn't some other currency stepped up to take the crown? Well, it turns out being the world's go-to currency is a really tough gig, and the main contenders, they've got their own issues.
Let's look at the euro. You know, its biggest problem is that it's a currency without a single country. There's no one euro bond that's as safe and easy to buy as a US Treasury bond. Instead, you have to buy German bonds or Italian bonds or Greek bonds, and they all come with different levels of risk. It's just messy. On top of that, for countries trying to move away from US influence, Europe is often seen as being too closely aligned with the US anyway, so it doesn't feel like a real alternative.
And then you have China's currency, the renminbi. Now, China's economy is an absolute giant, but its currency is kind of kept in a cage. Beijing has really strict rules called capital controls that limit how much money can flow in and out of the country. If you're a massive global pension fund or investor, you need to know you can get your money out whenever you want. That uncertainty, plus some of the political risks, it just means the renminbi isn't quite ready for prime time. Not yet, anyway.
So what's the bottom line here? Where does this all leave us? Well, it doesn't look like we're headed for some dramatic movie where the dollar is suddenly dethroned. It's more like a slow evolution of the entire global financial system.
Pretty much every expert agrees. The dollar's reign isn't going to just end overnight. There's just too much inertia built into the system, and like we just saw, there isn't a credible replacement waiting in the wings. But what we are seeing is a slow, undeniable, long-term shift. A move away from a world dominated by just one currency and towards what you might call a more multipolar currency world, where the dollar, the euro, the renminbi, and maybe others all share the stage.
And that really brings us to the final thought I want to leave you with. In a world that's becoming more complex, more fragmented, does it really even make sense anymore for everyone to be so reliant on a single country's currency? Maybe this shift isn't just possible, maybe it's inevitable. The real question is, what will that new world look like for all of us and our money?
Wow, that was something, right? But don't go anywhere, there's more coming, and it's gonna make you think in a whole new way. Quick reminder, if you like learning cool stuff without the fluff, subscribe now. You won't regret it.
Hey everyone, and welcome back to the Violet Vault. Today, we're going to demystify something that sounds super complicated, but actually affects your everyday life in huge ways. I'm talking about exchange rates. It's a topic that can seem a little intimidating, but I promise by the end of this, you're going to get it, and you'll see just how much it matters to your money. So has this ever happened to you? You're planning that dream trip, maybe to Europe or Japan. You check the currency exchange and you're feeling great. Your budget looks solid. But then, a few months later, right before you fly out, you check again, and bam, your money suddenly doesn't stretch nearly as far. What in the world just happened? Well, you've just experienced the power of exchange rates firsthand. All right, first things first, let's tackle the biggest question right out of the gate. Why should you even care about this stuff? Because this isn't some abstract economic concept just for Wall Street traders. Nope. This has a very real, very direct impact on your wallet. Okay, so what is an exchange rate? When you strip it all down, it's really simple. It's just the price of one currency if you were to buy it using another currency. So, for example, it answers the question, how many Japanese yen does it take to get your hands on one single US dollar? That number, whatever it is today, is the exchange rate. It's the invisible bridge that connects every economy on the planet.
You hear this on the news all the time, right? The news anchor says, the dollar is strong today. But what does that actually mean for you? Well, if your home currency is strong, that's fantastic news for you as a consumer. It means your money has more muscle, your vacation abroad is suddenly cheaper, that new phone or that car made overseas, also cheaper. But there's a flip side. It makes the stuff your country sells to the rest of the world more expensive. And a weak currency, it's the complete opposite. Traveling gets pricey, but your country's businesses can sell their products like hotcakes internationally.
Okay, so now we know what they are. But the real question is, why do they move around so much? What are the big forces that make these numbers dance up and down every single day? Let's pop the hood and take a look at the engine.
Our first major driver is something we've all been feeling in our bank accounts lately. I'm talking about inflation. It's basically how fast the prices for everything are going up, which, you guessed it, means your money buys less than it used to.
Think about it this way. Money is only good for what you can actually buy with it, right? So if a country is doing a great job of keeping inflation low, their currency holds its value. It's seen as stable. It's a safe bet. International investors see that and they think, hey, that's a good, safe place to park my money. So they all rush to buy that currency, which drives up the demand, and boom, its value goes up.
All right, on to driver number 2. Now, I want you to think of this one like a giant, powerful magnet for global money. We're talking about interest rates.
Okay, picture this. A country's central bank decides to raise its interest rates. All of a sudden, big-time investors all over the world look at their spreadsheets and go, whoa, I can get a much better return on my money over there. It's like the hottest new club in town just opened, and everyone wants to get on the VIP list. So they sell their own currencies to buy that country's currency, and all that demand causes its exchange rate to shoot up. It's a magnet, plain and simple.
And that brings us to our third big driver. This one is all about a country's international shopping habits. It's called the balance of trade, which is just a fancy way of saying the difference between how much stuff a country sells to the world versus how much it buys from the world. This really just boils down to classic supply and demand. Let's say the whole world can't get enough of a country's products. They have a trade surplus. Well, to buy all that stuff, foreign countries need to buy that country's currency first. All that demand pushes its value higher. On the other hand, if a country is buying way more than it's selling, a trade deficit, it's constantly selling its own currency to buy foreign goods, which floods the market and tends to push its value down.
So with all these powerful forces pushing and pulling on a currency's value, you might think it's just total chaos out there. Well, countries actually have a choice. They have to pick a strategy for how to manage their currency. And this leads to 2 completely different game plans: floating systems and fixed systems.
This slide really gets to the heart of the fundamental choice every country has to make. Do you let your currency float, where its value is decided by all those supply and demand forces we just talked about? That's what major currencies like the US dollar and the euro do. Or do you fix the value, where the government actually pegs it to another currency, like the dollar? This creates a ton of stability, which is awesome for trade, but it comes at a cost. You give up a lot of control over your own economy.
I love this analogy because it makes it so easy to understand. A floating currency is like a raft on the open ocean. Sure, it gets tossed around by the economic waves, and it can be a bumpy ride, but it adjusts, it bends, but it doesn't break. Now, a fixed currency, that's like a boat tied super tight to a big, stable dock. It feels incredibly calm and predictable, right up until a monster wave comes along. Then all that pressure builds up, and that rope can snap. And believe me, those ropes can definitely snap, and when they do, it can be catastrophic. This chart is a pretty stark reminder of what can go wrong. This is the 1997 Asian financial crisis. Essentially, several countries had their currencies pegged to a US dollar that was getting stronger and stronger. Eventually, the economic pressure became too much. Investors got nervous and started pulling their money out fast. The pegs broke, currency values absolutely collapsed, and it triggered a devastating financial crisis across the entire region.
Okay, now, before we start to wrap things up, I really want to bust a common myth about currencies that trips up almost everyone when they're first learning about this.
So you look at an economic powerhouse like South Korea, right? They make some of the most advanced technology in the world. And then you see their exchange rate, and it takes over 1,000 of their currency, the won, to equal just $1 US. And you just scratch your head and think, wait, what? How can the currency of such a strong economy look so weak? It feels completely backward.
And here it is. Here's the secret that makes it all click. The number itself is completely arbitrary. It's totally made up. A government could decide tomorrow to chop off a few zeros and call it a new won. It doesn't matter. What really matters is not the number printed on the bill, but the currency's stability, and most importantly, its purchasing power. The real question isn't about the number, it's about what 1,000 won can actually buy you on the streets of Seoul. That is its true value.
Whew. Okay, that was a lot of information, I know. We've covered a ton of ground, so let's bring it all home and boil it down. What are the key things you absolutely need to remember from all of this?
All right, here's your cheat sheet. First, remember this isn't just abstract theory. It directly hits your wallet through everything from travel to online shopping. Second, keep those 3 big drivers in your mind.
Inflation, interest rates, and trade. They're the engine. Third, don't get fooled by big numbers like 1,000 yen. It's not about the number of zeros, it's about purchasing power. And finally, remember that a country's choice between a floating or fixed system is a massive decision with huge consequences for its entire economy. So I'll leave you with this thought. The next time you're scrolling through the news and you see a headline about the Fed raising interest rates or a new trade deal, you'll know the story behind the story. You'll understand how that news sends ripples all across the world. I really hope this helped make things clearer for you, so let me know in the comments. After watching this, what's one economic headline you think you'll see differently now? I'd love to hear from you.
Wow, that was something, right? But don't go anywhere, there's more coming, and it's gonna make you think in a whole new way. Quick reminder, if you like learning cool stuff without the fluff, subscribe now. You won't regret it.
Every single day, trillions of dollars are zipping across the planet, right? It's what powers, well, everything. But have you ever stopped to think about how that actually works? It all depends on this hidden 50-year-old piece of infrastructure. And right now, that system is at the heart of an incredible, high-stakes battle for control. We're talking old systems versus new tech, and even world powers going head-to-head. Okay, let's get into it.
So let's ask the big question. How does it really happen? You know, when you send money from, say, New York to Rome, how does it physically or digitally get there? You might imagine some super complex transfer of digital gold or something, right? Well, the reality is actually way simpler, and I think a lot more interesting.
That's it. That's the secret. The entire global financial system, when you boil it all down, runs on messages. That's all it is. Secure, standardized messages that just tell banks where money is supposed to go. And for the last 50 years, one single system has been the undisputed king of sending those messages.
Now, to really understand this war for the future of money, we first have to get a handle on the system that's running the show right now. And it's a system that's so deeply embedded in everything, you've probably used it a dozen times without ever even hearing its name.
It's called SWIFT. Now, here is the absolute most important thing to understand. SWIFT is not a bank, okay? It doesn't hold your money, it doesn't have any accounts, it's a messaging network. Think of it like a cooperative, a club that's owned by thousands of banks all over the world. And this club has its own private, ultra-secure messaging app.
I love this analogy because it's just so perfect. It's basically a global text messaging service for banks. If your bank in the US wants to send your money to a friend's bank in Germany, it just sends a SWIFT text with all the instructions: who to pay, how much, and from which account. Simple as that.
So here's how it plays out. The SWIFT message, that's the instruction. But the actual money moves through this network of what are called correspondent banks. See, your local bank might not have a direct relationship with a small bank in Rome, so it sends the money through a bigger intermediary bank that they both trust. The SWIFT message zips across its network almost instantly, telling everyone what to do, while the actual funds kind of follow along that path, hopping from one bank's account to the next. It works, it's reliable, but man, it can be slow. And its age is starting to show in some much more dangerous ways.
Yeah, because when you have a 50-year-old system acting as the gatekeeper for trillions of dollars, well, it becomes a massive, glowing target for a whole new kind of bank robber. Incredibly sophisticated, sometimes even state-sponsored cybercriminals.
And this isn't just some theoretical threat. Just look at this timeline. You can see this pattern building and building. These aren't isolated incidents. What this data from F-Secure shows is a clear, escalating series of attacks. And get this, the hackers weren't breaking into SWIFT itself, which is super secure. No, they were finding vulnerabilities in the local banks connected to SWIFT, getting inside their systems, and then using the bank's own legitimate SWIFT terminal to send fake messages.
$81 million. That's how much was stolen in the huge Bangladesh bank heist back in 2016. The crazy part? The hackers were trying to steal almost $1 billion. They were only stopped because one of the payment instructions had a typo. A simple spelling mistake saved hundreds of millions of dollars. Just wow.
At the end of the day, it's just that simple, isn't it? It's the modern version of what the old bank robber Willie Sutton said. Why do hackers target the SWIFT system? Because that's where the money is. And this vulnerability, this fundamental crack in the foundation of global finance, has opened the door for a completely new idea. A way to reimagine what money even is.
So enter the challenger. And we're not talking about a simple upgrade to the old system. We're talking about a potential replacement, a whole new form of money, issued directly by the world's central banks, that could literally change everything.
This is a central bank digital currency, or CBDC. Now that definition sounds a little dense, I know, but that last little phrase is the most important part of this whole story, a direct liability of the central bank. So what on earth does that actually mean for you and me?
Okay, this is so important. Right now, the money you see in your bank account isn't really money, like a dollar bill in your wallet is. It's a digital IOU from your bank. It's a promise from, say, Bank of America to pay you. A CBDC, though, is the money. It's digital cash. It would be a direct claim on the central bank itself, just like physical cash is today. It's the difference between having a gift card for a store and having actual cash that's good everywhere. And listen, this isn't some sci-fi future we're talking about. It's already happening. China is leading the charge with its digital yuan, the eCNY. We're talking about the world's largest CBDC project by a massive margin. They've been building this for years, partly to get more control over their own economy, sure, but their ambition doesn't just stop at their borders. It's global. And what started as a technological race is very quickly turning into a full-blown geopolitical battle. A fight over who will get to build, and more importantly, control the new digital rails that the global economy will run on.
China's strategy here is actually pretty brilliant when you break it down. They're pairing their huge Belt and Road project, which builds physical infrastructure, with their new digital currency. The idea is simple. First, we'll build the physical roads and ports, and then we'll provide the new digital financial roads for all the trade that happens on them. A whole new system that operates completely outside of the current US dollar-based world.
So as you can imagine, the world is starting to split into two competing camps. On one side, you have Project mBridge, which is led by China and others, and they're trying to build one single shared platform for everyone's CBDCs to run on. And on the other side, you have the US and Europe, the G7 countries, who are moving way more cautiously. They prefer a model where every country has its own system, but they all agree on standards so they can talk to each other. It's like the difference between everyone agreeing to use Facebook versus some people using X, some using Instagram, but you can still send messages between them. Two very different philosophies.
But, and this is a really big but, this powerful new technology comes with a brand new and, frankly, a pretty terrifying risk. By making money safer and faster to move, we might actually be making the entire financial system more fragile.
To get what I mean, just take a look at this chart. It shows the bank run during the Greek financial crisis about a decade ago. People were scared their banks would fail, so they started pulling out cash. But they had to physically go to an ATM or a bank branch, and there were limits. Look at the timeline here. This whole thing unfolded over a matter of years.
And there it is. That's the new danger. With a CBDC, during a moment of panic, everyone could try to move all their money from their regular bank account to the ultimate safety of the central bank, all at the same time, with a single tap on their phone. A bank run at the speed of light. It's a scary thought.
So you can see why central bankers are in a tough spot. They know this is a massive risk, and they're desperately trying to figure out how to stop these potential digital runs. They're looking at a few different tools. They could maybe put a cap on how much CBDC you're allowed to hold. Or they could limit how much you can transfer in a day, kind of like an ATM withdrawal limit. But here's the catch. Every single solution has a major downside. If you tell people they can only hold a certain amount, they might panic and pull their money out before the crisis even hits. It's a real catch-22.
So all of this brings us back to the ultimate question. We are standing at a major fork in the road, facing a really fundamental choice about how the world's money is going to work for the next 50, maybe even 100 years.
So what happens next? Well, as I see it, there are really only two paths forward. In one future, the current system just gets an upgrade. SWIFT is already working on making things faster, and the old banking system gets a bit of a facelift. In that world, the US dollar probably stays on top, and not a whole lot changes. But in the other future, the world splits into these competing financial blocks, each with its own digital currency, its own rules, and that would be a much more fragmented and, honestly, a way more unpredictable world. And really, that's what this all comes down to. We are moving from a world where money is just this passive object to a world where money itself is an active piece of technology. It can be programmed with rules. And that leaves us with one final and I think absolutely critical question. As money itself becomes software, who do we trust to write the code?
Thank you for spending time with us here at the Violet Vault. Don't forget to like, subscribe, and drop your thoughts in the comments below. I'd love to hear from you. Until next time, stay focused and keep growing.